February 20th, 2025. President Trump stood on Air Force One and said something that sent shockwaves through every financial institution on Earth. We're going to go into Fort Knox to make sure the gold is there. He paused. If the gold isn't there, we're going to be very upset. 24 hours later. Senator Rand Paul demanded emergency vault access. March 19th, deadline. And here's what nobody is telling you. If those vault doors open and reveal what insiders have suspected for 52 years, silver doesn't stop at 115. It doesn't stop at $150. The number is $200 and possibly far beyond. But the reason why will shock you. Welcome to Currency Archive. If you've spent decades building wealth, protecting your family, and watching governments make promises they never keep, then you're in the right place. We don't do entertainment here. We do intelligence. Hit that subscribe button like you'd lock a vault, because what we're about to reveal doesn't stay public for long. And tell us, where are you watching from today? New York, London, Dubai, Texas? Drop your location below, because this story affects every corner of the financial world. On February 20th, 2025, President Donald Trump stood before reporters on Air Force One and made a statement that financial analysts would later describe as the most significant monetary policy signal in 50 years. We're going to go into Fort Knox to make sure the gold is there, Trump said. He paused, looked directly at the camera, and added, if the gold isn't there, we're going to be very upset. The President of the United States had just publicly questioned whether America's sovereign gold reserves actually existed. 24 hours later, Senator Rand Paul sent a formal letter to Treasury Secretary Scott Bessent. The letter demanded full access to the United States Bullion Depository at Fort Knox. Paul requested an in-person inspection no later than March 19th, 2025. In his letter, Paul wrote that 42 years had passed since any civilian had been allowed to enter and view the gold vault. But the real number was worse than that. The last comprehensive public audit of Fort Knox occurred in 1974. That was 52 years ago. For context, 52 years is longer than most business owners have been alive. It is longer than the entire career span of today's senior executives. It represents two complete generations of financial leadership who simply accepted government assurances without verification. Financial historians immediately recognize the significance. When a sitting president publicly doubts his own government's reserve claims, institutional credibility has already collapsed. The audit announcement was not the beginning of a crisis. It was confirmation that a crisis had been developing for decades. The 1974 audit itself had been controversial. Congress authorized it during the Watergate scandal when public trust in government had reached historic lows. A small group of congressmen and journalists were allowed inside Fort Knox for a single day. They observed gold bars stacked in a vault. They were not allowed to verify serial numbers against official records. They were not allowed to conduct independent assays to confirm the gold's purity. They were not allowed to verify the total weight against official claims. The tour lasted 6 hours. The government declared the audit complete. No further public inspection would occur for the next 52 years. This lack of transparency created a problem that compounded over time. Official records state that the United States holds 261.5 million ounces of gold in Fort Knox and other depositories. At current prices, that represents approximately $800 billion in assets. But those records rely entirely on government statements that have not been independently verified in half a century. Business leaders understand a basic principle of accounting. Assets that cannot be verified do not inspire confidence. Assets held without transparency create doubt, and doubt, once established, spreads quickly through financial markets. Senator Paul's letter raised questions that professional treasury managers had been asking privately for years. Had the gold been leased to foreign central banks? Leasing is a common central bank practice where gold is loaned to commercial banks while still being counted as reserves on government balance sheets. If Fort Knox gold had been leased, it would still appear in official statistics, but it would not physically exist in Kentucky. Had the gold been swapped for other assets? Central banks sometimes exchange gold for foreign currency or bonds and transactions that remain classified for national security reasons. The gold moves offshore, but official records continue showing it as domestic reserves. Had the gold bars been replaced with tungsten cores covered in gold plating? This specific concern emerged in 2009 when Chinese officials discovered fake gold bars in their own reserves. The bars had tungsten cores, which have nearly identical density to gold, covered with a thin layer of real gold. They passed basic weight tests, but failed detailed assays. These were not conspiracy theories. These were standard due diligence questions that any institutional investor would ask before accepting asset claims worth $800 billion. The Trump administration's decision to announce the audit publicly created a strategic timing problem. In normal circumstances, audits occur quietly. Results are released after verification is complete. But Trump chose to announce his intention before conducting the inspection. This decision meant that financial markets now had a known deadline, March 19th, 2025. Professional investors understood the implication immediately. If the audit revealed significant discrepancies, precious metals prices would surge. If the audit confirmed full reserves, prices might stabilize or decline. But waiting until March 19th to position portfolios meant buying or selling after price discovery had already occurred. The business community faced a decision point. They could maintain current positions and accept the risk of being wrong, or they could adjust their treasury management before the audit results became public. What made this situation particularly significant was timing. The audit announcement occurred while silver was trading at $115 per ounce, already at historically elevated levels. Multiple institutional analysts, including Bank of America, had published research forecasting that silver would reach $200 per ounce in 2026. The question facing business owners was simple but urgent. Were these 200 forecasts based on supply and demand fundamentals that already existed? Or were analysts pricing in the probability that Fort Knox would be found empty? The answer would determine whether silver's rise to $200 was inevitable or whether it was about to accelerate far beyond that level. While politicians debated vault inspections and government transparency, a different crisis was unfolding in the physical silver market. This crisis had nothing to do with Fort Knox audits or presidential statements. It was driven by mathematics, industrial demand, and a supply shortage that had been building for nearly a decade. The numbers told a story that most investors had completely missed. Global silver mining production in 2025 reached approximately 830 million ounces. That number represented every ounce extracted from the earth across every mining operation worldwide. It included primary silver mines, where silver was the main target. It included secondary production, where silver came as a byproduct of copper, lead, and zinc mining. But global demand in 2025 exceeded 1.2 billion ounces. The deficit was not small, it was not temporary. It was 370 million ounces annually, a gap so large that it would drain every available stockpile within 3 years if production and demand remained constant. Where was this demand coming from? Solar panel manufacturing consumed approximately 180 million ounces annually. Each solar panel required silver paste for electrical conductivity. Engineers had spent 20 years trying to reduce silver content per panel. They had succeeded in cutting usage by 40%. But global solar installations had increased by 600% during the same period. The net result was that solar demand for silver continued rising despite efficiency improvements. Electric vehicle production consumed another 55 million ounces. Each EV required roughly 1 ounce of silver for electrical contacts, circuit boards, and charging systems. As global EV sales approached 15 million units annually, this demand category was growing at 25% per year. Electronics manufacturing used 240 million ounces. Every smartphone, laptop, television, and appliance contained silver. 5G infrastructure build-out added another layer of demand that had not existed 5 years earlier. Defense and aerospace applications consumed 30 million ounces. Missile guidance systems, radar arrays, and military communications equipment all required silver's unique properties. This demand was completely inelastic. Defense contractors would pay any price to secure necessary materials. Medical applications used 45 million ounces for antimicrobial coatings, wound dressings, and medical devices. And investment demand, from individuals buying coins and bars, added another 250 million ounces annually. The supply side offered no relief. Major silver mining companies had drastically reduced exploration budgets between 2015 and 2022. When silver prices fell to 14 per ounce in 2020, new mine development became economically unviable. Companies cut capital expenditure. Exploration teams were downsized. Promising deposits remained undeveloped. The result was a coming production cliff. Existing mines were depleting. Few new projects were entering production. Industry analysts projected that annual mine supply would decline by 5% between 2026 and 2030 unless silver prices remained elevated long enough to justify new development. But mine development takes 7 to 12 years from discovery to production. Even if companies began aggressive exploration today, new supply would not reach markets until the mid-2030s. This created a structural problem that no amount of government policy could solve quickly. The COMEX, the primary futures exchange for silver trading, reported registered inventory of just 42 million ounces. Registered inventory represented physical silver available for delivery against futures contracts, but open interest on COMEX silver contracts represented claims on more than 900 million ounces. The ratio was 21 to 1. For every physical ounce available, 21 paper claims existed. This fractional reserve system worked perfectly well under normal conditions. Most futures contracts settled in cash rather than physical delivery. Traders were speculating on price movements, not seeking actual metal. As long as fewer than 5% of contracts demanded delivery, the system remained stable. But what happened when trust collapsed? What happened when institutional investors stopped accepting cash settlement and demanded physical metal? The Shanghai Gold Exchange provided a preview. Physical silver in Shanghai traded at a $12 premium over COMEX prices. This premium existed because Chinese buyers insisted on physical delivery. They did not trust paper claims. They wanted metal they could touch, weigh, and store. That $12 premium represented a warning. It showed that when buyers demand physical settlement, prices diverge sharply from paper markets. Basel III banking regulations, which took full effect in 2023, accelerated this trend. Under Basel III, banks could no longer count unallocated paper gold and silver as Tier 1 assets. They needed physical metal in allocated accounts. This regulatory change forced European banks to convert paper positions into physical holdings. The result was steady pressure on available physical supply. Banks were not buying silver to speculate. They were buying to meet regulatory requirements. This demand would not disappear if prices rose. It would continue regardless of price level. Bank of America's commodity research team had published detailed analysis explaining their $200 silver target. Their model was not based on speculation or momentum trading. It was based on supply deficit mathematics. The analysts calculated that at current industrial demand growth rates combined with declining mine production, silver would need to reach $185 to $210 per ounce to accomplish two things. First, prices needed to incentivize new mine development. Second, prices needed to ration industrial demand by forcing manufacturers to seek alternatives or reduce consumption. Jim Rickards, a financial analyst with decades of experience in institutional markets, had reached similar conclusions through different methodology. Rickards focused on historical gold to silver ratios. Throughout most of monetary history, silver traded at ratios between 15:1 and 31 relative to gold. With gold trading above $3,000 per ounce, a reversion to historical ratios implied silver prices between $100 and $200. Robert Kiyosaki approached the question from a monetary perspective. He emphasized that central banks were accumulating gold at record rates while ignoring silver. This created an opportunity imbalance. When institutions eventually recognized silver's industrial scarcity, they would attempt simultaneous position entry. That rush would overwhelm available supply. What made these analyses particularly credible was their convergence. Three analysts using completely different frameworks, supply deficit modeling, historical ratio analysis, and monetary policy assessment, all arrived at price targets between $185 and $210. But these projections had been published before Trump announced the Fort Knox audit. The supply crisis was real. The deficit was documented. The price targets were mathematically justified. The audit added an entirely new variable to an already unstable equation. The global precious metals market operated on a foundation that most investors never questioned. That foundation was trust. Trust that vault certificates represented real metal. Trust that government reserves matched official claims. Trust that unallocated accounts could convert to physical delivery upon request. This trust had been built over centuries. It was about to be tested in ways that would expose every structural weakness in the modern bullion banking system. Understanding what happens when trust collapses requires understanding how the system actually works, behind the curtain of official statements and regulatory assurances. A business owner in Dallas purchases what he believes is 1,000 ounces of silver through a major bullion bank. He receives a certificate. The certificate states that he owns 1,000 ounces. But the certificate comes with specific language in the fine print: unallocated account. In unallocated accounts, the buyer owns a claim on silver, not specific bars. The bank pools all unallocated claims together. The bank is not required to hold 100% physical backing for these claims. Industry standards typically require only 10 to 20% physical reserves against unallocated obligations. This means the Dallas business owner's 1,000-ounce certificate might be backed by just 100 to 200 physical ounces in the bank's vault. The remaining 800 to 900 ounces exist as accounting entries, promises that can be fulfilled by purchasing metal in the future if the owner requests delivery. This system is called fractional reserve bullion banking. It mirrors how regular banks operate with deposits. Banks do not keep all depositor funds in cash. They lend most deposits out while maintaining fractional reserves to meet normal withdrawal demands. The system works smoothly when only a small percentage of certificate holders request physical delivery simultaneously. But when trust breaks, when certificate holders lose confidence that their claims are backed by real metal, everyone rushes to convert paper into physical at the same moment. The London Bullion Market Association oversees the largest precious metals market in the world. LBMA handles approximately $20 billion in gold transactions daily and $3 billion in silver. But LBMA market structure relies heavily on unallocated accounts and fractional reserves. A 2016 internal audit conducted by the Bank of England revealed something remarkable. The audit found that total claims on gold stored in London exceeded physical gold inventory by a factor of approximately 40 to 1 for certain time periods. For every physical ounce, 40 different parties held paper claims believing they owned that ounce. This was not fraud. This was how the system was designed to operate. Multiple parties could hold claims on the same ounce because the system assumed they would not all demand delivery simultaneously. But what happens when simultaneous delivery demands occur? History provided several examples of what economists called redemption crises. In August 1971, President Richard Nixon closed the gold window. Foreign central banks had been redeeming dollars for gold from U.S. Treasury reserves. When redemption demands exceeded available supply, Nixon simply refused further conversions. Dollar holders who believed they owned claims on gold discovered their claims had been converted to paper promises with no physical backing. Gold prices subsequently rose from $35 per ounce to $850 within 9 years. In October 2011, MF Global, a major commodities brokerage, collapsed. Customers who believed they held allocated gold and silver in segregated accounts discovered that MF Global had commingled their assets with company funds. When bankruptcy occurred, customer metal disappeared. Years of litigation followed. Many customers received only partial recovery. In 2013, Germany's Bundesbank requested the return of 300 tons of gold stored with the Federal Reserve Bank of New York. The Federal Reserve initially resisted. When the Fed finally agreed, they proposed a 7-year timeline for returning Germany's own gold. Why would returning already owned gold require 7 years? The implication was clear. The gold was not sitting in a vault waiting for pickup. It needed to be acquired, possibly by purchasing in open markets or recalling metal that had been leased to third parties. These historical episodes revealed a pattern. When institutional trust breaks, authorities respond by delaying delivery, imposing restrictions, or simply refusing redemption entirely. The Fort Knox audit created the conditions for a modern redemption crisis on a scale never before witnessed. Consider the logical chain reaction if the audit revealed significant discrepancies. Stage 1 would begin within hours of the audit announcement. Sophisticated institutional investors would immediately recognize that if U.S. government gold reserves were fictional, then all government-assured precious metals holdings were suspect. They would begin converting unallocated positions to allocated accounts, demanding physical delivery before banks could impose restrictions. Stage 2 would hit bullion banks within 48 to 72 hours. Banks would face delivery requests exceeding their physical reserves by large multiples. They would have two choices: purchase massive quantities of physical metal in spot markets to meet delivery demands, or impose delivery delays and force cash settlement. Either choice would cause prices to spike violently. Stage 3 would cascade through derivative markets. The Bank for International Settlements estimates that global silver derivatives exceed $500 billion in notional value. But the entire physical silver market, every ounce mined, stored, or available for purchase, represents only $140 billion at current prices. Derivative contracts outnumber physical metal by more than 3 to 1. When derivative counterparties lost confidence, they would rush to close positions or demand physical settlement. This would create feedback loops where rising prices triggered margin calls, forcing additional buying, driving prices higher still. Stage 4 would spread to exchange-traded funds. Popular silver ETFs like SLV hold billions in assets, but ETF prospectuses contain legal language, allowing trustees to settle redemptions in cash rather than physical metal under certain circumstances. If those circumstances arose, ETF shares would trade at discounts to net asset value as investors realized their shares might not convert to physical metal. This would accelerate the flight from paper to physical. Stage 5 would reach retail markets. Coin shops and bullion dealers operate on thin inventory margins. They sell forward based on expected delivery from wholesalers and refiners. When wholesalers stopped delivering, which occurred briefly in March 2020 during pandemic panic, retail premiums explode. Dealers who normally sold silver eagles at 3 over spot suddenly charged 10 or 15 to 1 premiums. Some stopped selling entirely until they could secure reliable supply. The mechanism was straightforward. Paper claims on silver outnumbered physical ounces by enormous ratios. As long as most claim holders accepted paper, the system remained stable. But when trust collapsed and claim holders demanded physical delivery simultaneously, available supply would be overwhelmed within days. Analysts at Bank of America had modeled this scenario. Their research suggested that a widespread loss of confidence in government precious metals reserves could drive silver to $200 within 6 to 9 months through pure redemption dynamics, separate from any industrial supply deficit. The audit was not scheduled until March 19th, but markets do not wait for official results. Markets price in probabilities immediately. The question facing every business owner with treasury responsibilities was no longer whether to hold precious metals. The question was whether paper claims would survive what was coming, or whether only physical possession would matter when the trust mechanism finally broke. The Fort Knox audit represented far more than a simple inventory verification. It was a stress test of the entire post-1971 monetary system occurring at precisely the moment when that system faced challenges from multiple directions simultaneously. Understanding why the Trump administration chose to conduct this audit now, after 52 years of opacity, required understanding the larger geopolitical chess game unfolding across global financial markets. In August 2023, the BRICS nations, Brazil, Russia, India, China, and South Africa, announced expansion to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. This expanded bloc represented 45% of global population and 35% of global GDP. More importantly, it represented a coordinated effort to reduce dependence on dollar-denominated trade and dollar-based reserve systems. China and Saudi Arabia had begun settling oil transactions in yuan rather than dollars. This was not theoretical, it was operational. Major oil flows that had been priced in dollars for 50 years were now clearing in Chinese currency. Each transaction that bypassed the dollar system reduced demand for U.S. Treasury securities and diminished America's ability to finance deficits through foreign purchases of government debt. Russia had been systematically divesting Treasury holdings since 2018 and converting reserves into gold and alternative currencies. By 2024, Russia held virtually zero U.S. Treasury bonds, down from $150 billion a decade earlier. Central banks globally were purchasing gold at rates not seen since 1967. The World Gold Council reported that central bank gold purchases in 2024 exceeded 100 tons, the second highest annual total in recorded history. These institutions were not buying gold to speculate on price movements. They were buying gold to diversify away from dollar reserves because they no longer trusted the long-term stability of dollar-based systems. The Federal Reserve's balance sheet had expanded to $9 trillion during COVID-19 response and remained elevated. This represented money creation on a scale that had no historical precedent outside wartime emergencies. Bond markets were pricing in long-term inflation expectations that contradicted Fed statements about price stability. Regional bank failures in March 2023. Silicon Valley Bank, Signature Bank, First Republic had exposed fragility in the banking system that official stress tests had completely missed. These banks had been considered well-capitalized and properly regulated. Their collapse within 48-hour periods demonstrated that official assurances meant little when confidence disappeared. The commercial real estate sector faced what analysts called a slow-motion crisis. Office buildings in major cities were trading at 40 to 60% discounts from 2019 valuations. Banks holding commercial real estate loans faced potential write-downs exceeding $500 billion. But these losses had not yet been recognized because regulatory accounting rules allowed banks to carry loans at face value until they matured or defaulted. Into this environment of mounting systemic stress, President Trump announced a Fort Knox audit. The timing was not coincidental. If the audit confirmed full reserves, it would provide a moment of confidence restoration. It would demonstrate that despite all other challenges, America's sovereign wealth remained intact. It would provide a foundation for arguing that dollar skepticism was overblown. But if the audit revealed discrepancies, the Trump administration would be acknowledging problems rather than having them exposed by foreign governments or investigative journalists. Controlling the narrative by admitting problems first was better than being caught in a cover-up. Either way, the audit represented recognition at the highest levels that monetary system credibility had become critical enough to require verification rather than continued assumption. For business owners and corporate treasury managers, this created a decision framework that could not be postponed. The first option was maintaining current positions, typically dollar-denominated cash, treasury securities, and conventional portfolios. This position carried the risk that if the audit revealed major problems, purchasing power would decline significantly before protective positions could be established. Dollar-based assets would devalue rapidly if global confidence in U.S. monetary management collapsed. The second option was paper precious metals exposure through ETFs and unallocated accounts. This provided some commodity price exposure, but carried substantial counterparty risk. As discussed in previous sections, paper claims might not convert to physical metal during redemption crises. ETFs could impose cash settlement. Banks could delay delivery indefinitely. This position was better than pure dollar exposure, but still vulnerable to systemic trust collapse. The third option was allocated physical precious metals held in professional vault storage. This eliminated most counterparty risk. The metal was specifically identified, segregated, and insured. But allocated storage carried higher costs: storage fees, insurance premiums, and reduced liquidity. Converting allocated holdings back to cash during normal market conditions took days or weeks rather than instant electronic settlement. The fourth option was direct physical custody, owning metal and storing it personally or in private facilities. This maximized security against systemic breakdown but created operational challenges. Storage security became the owner's responsibility. Insurance for large holdings was expensive. Liquidity was limited because selling physical metal required finding buyers, arranging transportation, and completing transactions that could take days. Professional treasury management required matching position selection to specific risk profiles and business needs. A technology company with strong cash flow and no immediate liquidity needs could justify allocated or direct custody positions. Their primary risk was long-term purchasing power preservation. They could accept reduced liquidity in exchange for maximum security. A retail business with variable seasonal cash needs required higher liquidity. For them, some paper precious metals exposure combined with allocated holdings might provide better balance, accepting some counterparty risk to maintain operational flexibility. A manufacturing firm with international operations and currency exposure might use physical precious metals as a dollar hedge while maintaining working capital in multiple currencies. Their risk was concentrated dollar exposure, combined with supply chain disruptions that could be partially offset by commodity holdings. But across all scenarios, one principle remained constant. The March 19th audit deadline created a known decision point. Waiting until audit results became public meant making decisions after price discovery had already occurred. Markets do not wait for official announcements. They price in probabilities immediately based on available information. By the time audit results were released, silver prices would have already moved to reflect outcome expectations. Bank of America's $200 target assumed that supply deficit fundamentals alone would drive prices to that level. Jim Rickards' analysis suggested historical ratio reversions pointed to similar levels. Robert Kiyosaki's monetary analysis indicated institutional recognition of silver scarcity would trigger sharp revaluations. All three analyses were completed before the audit announcement. The audit added a binary catalyst to fundamentals that already justified substantial price increases. If the audit confirmed reserves, silver might stabilize at current levels before resuming upward movement driven by industrial deficits. If the audit revealed problems, silver could reach $200 within months rather than years, not because of speculation, but because trust collapse would trigger the redemption dynamics that overwhelm fractional reserve systems. The question facing business leaders was not whether precious metals deserved allocation within diversified portfolios. The question was whether paper claims would maintain value through what was coming, or whether only physical possession would provide actual protection. 52 years of opacity was about to end. The financial system built on trust rather than verification was about to face a moment when verification became unavoidable. Whether Fort Knox proved full or empty, the fact that verification had become necessary signaled that the trust mechanism had already failed. Silver's path to $200 was not speculation. It was the mathematical result of decades of supply deficit meeting the moment when trust collapsed and paper claims sought conversion into physical reality. The audit did not create the crisis. It revealed what had been building for half a century.